Okay, understood. All right. So we've covered up to borrowing so far. So far we've seen fixed assets, inventories, loans, advances, investments, securities, guarantees, related reporting, borrowings, and now we move on to requirement on fraud. Okay. Fraud related clause was already there in the existing CARO 2016. Only thing, the existing CARO used to talk about fraud committed on the company by the officers or employees of the company. Now there is no such restriction. Any fraud committed on the company, whether it is by officers or employees or other parties, everything needs to get covered within that clause. And similarly, additional subclasses have been included. One is when the fraud amount involved is more than 1 crore, there is a specific reporting requirement for the auditor to report the matter to the central government. Below 1 crore, there is no requirement to report to central government. You will have to bring it to the notice of the board of directors and if applicable, the audit committee. But when it is in excess of 1 crore, in addition to bringing the matter to the attention of board of directors or audit committee and seeking their responses, you are also required to report the matter to the central government through file form ADT 4. So you have a clause, subclause that talks about whether any such report was filed by the auditors under section 143, clause 12. And the next new item, in case there are any whistleblower complaints that have been received by the company during there, whether those have been duly considered by the auditor. Now, this is a point, both of these for that matter, in the context of fraud as well as whistleblower complaints, while we make inquiries from the company, in case we get a negative response, there is no such instance. All that we can do is obtain a representation to that extent in the MRL and close the matter there. But if at all we come across any such situation when going through any of the documents as part of the audit or hearsay discussions within the company, we come to know of an instance of fraud or any such whistleblower complaints, then we'll have to be careful in ensuring that we try to identify what the matter is and address it suitably, right? Always keep your eyes and ears open with respect to such matters. Nidhi company, there was a specific clause already. They've just added one more subclause within that, wherein they are talking about the auditor having to report on any default in payment of interest or repayment with respect to the deposits that have been taken by the Nidhi company. So in the existing clause, there is an additional subclause that has come in, not very common. I'll not spend too much time on this. Similar to the subclause on utilization of short-term funds for long-term purposes, this is also a requirement that was previously there in the old CARO of 2003, which got removed in subsequent years, but then it is resurfacing now. So where internal audit is applicable to the company, the auditor is required to talk about whether the internal audit system is commensurate with the size and nature of its business. So depending on the volume of activities of the entity, you will have to discuss on, report on whether the internal audit function is suitably structured and whether it is being done properly. And we will also have to talk about whether the reports issued by the internal auditors have been duly taken into consideration for the purpose of undertaking our statutory audit and also in considering our audit report. Okay. Now, this particular table talks about the entities for whom internal audit is applicable. It's more self-explanatory in nature, so I will not spend too much time on this. Just remember, for all listed companies, it is applicable. When it comes to private companies, companies which have a turnover of more than 200 crores, it becomes applicable. Similarly, in case the outstanding loans and borrowings from banks and financials are in excess of 100 crores, equal to or more than 100 crores, then also it becomes applicable. I will anyway be sharing this PPT later on, so you can take a look at it later on. So this section 138 read with rule 13 will give you the answer on the companies for whom internal audit is applicable. Right? NBFC, there was a clause already which used to talk about whether the certificate of registration has been obtained or the company is, not having such a certificate. We don't have NBFC clients as it stands now, right? But I'll just spend a little bit of time so that you guys are aware, at least from an academic perspective. So there are few additional subclasses that got inserted within this particular clause. First one is whether the company has carried on any non-banking financial activities or housing finance activities without holding a valid certificate of registration issued by the RBI, right? So typically these activities, NBFC activities and housing finance activities, cannot be carried on unless the company applies and obtains a certificate of registration from the RBI. They cannot carry out any such activity. So whether any such instances have been noticed, whether it is a core investment company. Right now, what is CIC? CIC is basically an investment company. When I say investment company, something that holds more than 50% of its assets in the form of financial assets, like shares, securities, loans given, and all that. Similarly, more than 50% of its income is in the nature of income from such investments, like interest from loan, dividend from investments. All right. So where the predominant nature of the activity undertaken by the company is more of an investment and lending company, it gets classified as a CIC, subject to the certain thresholds. I think I've in fact shared one link wherein the list of core investment companies as it stands now are available. And not all investment companies will be classified as core investment companies, only those with very high volume. Okay. For example, say Tata Capital, right? Or say Tata Sons, or you take a Bajaj Finserv, Bajaj Finance, all right? In fact, Bajaj Finserv and Finance, they're more of NBFCs. So basically investment and holding companies which, are holding assets worth multiple crores, right? Multiple thousands of crores. Those are the ones that are typically classified as core investment companies. I don't recollect the exact thresholds, but there is a separate RBI circular that deals with core investment companies, not very relevant for our set of clients, right? So in case that company is classified as a core investment company, whether it is continuing to fulfill the criteria for such classification is one subclass that needs to be talked about. If you are an exempted or unregistered core investment company, right? So like I said, smaller thresholds, although you might be a core investment company, you are not required to get yourself registered. In such scenario, whether the thresholds below which you need to have numbers for continuing the exemption and non-registration are there, because if the thresholds are crossed, then you might have to go and apply to the RBI and get a registration as a CIC. In case there are multiple CICs as part of a group, which you can see in a lot of business conglomerates like Tata Group or the Bajaj Group and all that, in those sort of scenarios, the number of CICs will also have to be reported, right? So core investment company as a concept is not very relevant for our set of clients. But just keep that in mind in case you come across any company which is dealing predominantly in investment in their group concerns, lending money to their sister concerns and all that, then there is a chance that this particular subclause might become applicable. Right? This one again is a old clause that has got reintroduced. Whether any cash losses have been incurred by the company either in the financial year which is being reported upon or in the immediately preceding financial year. So when we talk about audit of financial year 21-22, you are required to report on whether there are any cash losses in 21-22 or the year prior to that, which is 2021. Right? Now, how do you quantify cash losses? Anyone? Sorry, I think somebody said something. Nothing, huh?
No. I asked Ovia to reply. He's the one for Mass Hospital we have to print it.
Cash loss. Yes, Ovia, how did we quantify cash loss there?
loss of the company as adjusted against non-cash items like depreciation and other such non-cash items.
Okay. So theoretically, what Ovia is saying, all right, the loss of the company, but after excluding non-cash items of expenditure, all right, or income for that matter. So two common items which will come up is your deferred tax expense or credit and your depreciation and amortization expense. These two are non-cash items generally. So your profit after tax adjusted for depreciation and also adjusted for deferred tax will generally give you the cash loss figure. And in case there are cash losses incurred in the latest financial year which is being audited or the immediately preceding financial year, the amount needs to be disclosed in our audit report as part of CARO. Okay. The next clause, the new one, in case there is any resignation of the statutory auditor, whether the incoming auditor has taken into consideration any issues, objections, or concerns that have been raised by the outgoing auditors. Right? Now, this is bringing in additional responsibility on the incoming auditor, who can no longer restrict themselves to just seeking a no objection from the previous auditor and closing the matter there. It will now require conscious efforts by the incoming auditor to do two things. One, they will have to formally communicate with the company itself to understand what sort of communications have been received by the outgoing auditors during the last year's audit engagement, what objections or what issues were raised, how those were addressed, what was the response given by the company and all that. And number two, the incoming auditor can also preferably communicate with the outgoing auditor, not just with the objective of seeking no objection, but also positively engage with them and try to understand what sort of challenges were faced during the course of the audit, what issues were raised, how those were handled, whether there are any open issues that are continuing. All right. So this to a certain extent helps in continuity for the incoming auditor to ensure that they are able to start off where the outgoing auditor left, especially in the context of any issues or objections that might not have got addressed suitably in the previous year. Right? So now this requirement, like I said, requires additional positive efforts by the incoming auditor and communicating both the auditee company as well as the previous auditor. And while the clause is worded in such a way that whether there is any resignation during the year and all that, sometimes there might be resignations that happen after the year end. For example, let's say an existing auditor resigns now and our firm gets appointed as the statutory auditor. It might not be appropriate to take a view that I will talk about this clause only in the next year because resignation happened during 21-20, the 22-23. All right. The year for which we are now going to audit 21-22, for that year itself, you are now an incoming auditor. So although the resignation has happened subsequent to the year end, in my personal opinion, it is more appropriate to talk about this clause in the audit report of 21-22 itself. All right, because when you talk about the next year, you become a continuing auditor. You are not an incoming auditor. Only for financial year 21-22, you are an incoming auditor. And so that is the year in which this clause gains more prominence. This is a very good question for which nobody knows the answer, or sometimes different people have different answers. But somehow the Ministry of Corporate Affairs expects us to respond to this. So the question is, on the basis of certain financial ratios, which we will cover later, Schedule 3 has now brought in certain financial ratios that need to be disclosed. And on the basis of the aging of financial assets, in subsequent slides, you will see you are required to talk about aging of your trade receivables. All right, when you expect to, or rather how old the trade receivables are. So aging of financial assets, expected date of realization of the financial assets, and the expected date of payment of financial liabilities. You have financial ratios on one side, you have aging of financial assets and liabilities, and you also have expected dates of realization or payment of financial liabilities. Then any other information that accompanies the financial statements, and the auditor's own knowledge of plans of the board and management in terms of what they intend to undertake for the next 6 months, 12 months, any capex plans, any expansion plans, any reduction in production. Okay. Any knowledge that you have that about the board or management's plans. Based on all of this, the auditor is required to give his opinion as to whether on the date of issuing the audit report, any material certainty exists with respect to the company's ability to meet its liabilities within the next 1 year. When I say next 1 year, not from the date of the audit report, 1 year from the date of the balance sheet. All right. So let's get into some specific dates. Now we are looking at financials of 21-22 that are being audited, right? Let's say we are issuing our audit report, say sometime in June, right? So what we are required to talk about is, based on all of these information, whether during the period from 1st April 2022 till 31st March 2023, while signing on the audit report in June, we are of the opinion that there is a likelihood that the company might not be able to fulfill its obligations or liabilities during this 1 year period of April 2022 to March 2023. All right. Now this is a very tricky question. All right. For us to give a positive response, or for that matter, even to give a negative response, we need to have proper work papers in place to substantiate on what basis the calls are being taken. Okay. Now, this might warrant us to get from the management the expected realization of current assets in each of the subsequent 12 months. All right. Similarly, it might warrant getting a cash flow projection, both inflow and outflow, for the next 12 months on a monthly basis. So how much creditors will have to be repaid in that particular month? What is the loan repayment that needs to be done? What is the interest that needs to be serviced? All right. Some sort of a 12-month projected cash flow has to be prepared for us to say that yes, the company will be able to service its liabilities without any major challenges. All right. Now, another view that can possibly be taken is, with respect to current assets and liabilities, you can look at the possibility of restricting the cash flow projections for the next 3 or 4 months by when the assets and liabilities existing on the balance sheet date be closed, right? So typically, if you take a debtor, you are not going to take 12 months to realize that debtor usually, right? It will usually get realized in the next 2-3 months. Similarly, your creditors will get realized in the next 3-4 months. All right. So you can even consider restricting the cash flow projections for those 3-4 months until that realization is complete. But any current liabilities that will get repaid even after that period will have to be duly considered for the subsequent period projections. Like for instance, your current maturities of long-term borrowings, which will typically have a monthly repayment for the next 12 months. All right. Those sort of items will have to be considered for the 12-month period. So I think the ideal recommendation would be that a cash flow be prepared for the next 12 months to substantiate that the settlement of liabilities is feasible, and up to the period on which the audit is being undertaken, you can anyway look at whether there have been any defaults in repayment of monies to lenders, any delays in repayment of dues to creditors. All right. So until the date of the audit report, events have already unfolded. It is not something that is going to happen that needs to be projected, right? Let's say signing off in June or July. Until the date, we can look at whether the company has been satisfying its obligations and liabilities on time, and that also give you some additional comfort in terms of the ability of the company to satisfy. All right. Now, the institute guidance note does not give too much of information or guidance on this matter. So I think over time we will have to look at what is the extent of documentation that we need to have for us to substantiate that the solvency is not going to be affected. For companies which have been historically profitable, their current ratios are very good, say for example 1.52, all right, those sort of scenarios, you have a very easy case to say that there is no major challenge in solvency unless something untoward happens after the year end or during that year, which causes a drastic impact on the financial position. But cases where the companies are already in a struggling phase where they are not making much of profits or they're incurring losses, then this clause becomes very critical. You will have to have proper working papers in place to substantiate your opinion on this matter. Okay. Yeah. So some of the aging disclosures which I mentioned, which would help in determining the solvency position, which are required to be part of Schedule 3, right? So this is with respect to trade payables. Now, if you would remember, there was no aging requirement at all with respect to trade payables. Only for trade receivables, we had to split it between the 6-month period and beyond 6 months. Now, even for trade payables, there is an aging requirement that has come in. This is not something that has to come in that particular schedule itself. It can come below, right? The schedule can still say how much of dues are pending for payment to micro and small enterprises, how much is for others, and below that this table can be disclosed. And the aging that is prescribed in Schedule 3 is only those 4 columns in orange, which is less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years, right? But the way it is worded is such that the unbilled dues and dues which are not due are also required to be disclosed separately, right? That is what the Schedule 3 requirement says. So what ICA is recommended, those two can also be included as 2 separate columns itself, so that the entire information is contained in a single table itself. So not due is something that we can understand. What is not due? The due date is falling after the balance sheet date. So we are looking at 31st March 2022. Let's say there were some goods or services that were purchased in the month of March, say 10th of March. There is a 30-day credit period. So due date for payment is 10th of April. So that is an amount which is not yet due as at the balance sheet date. But what is unbilled dues? Now, because of this change in aging itself, aging requirement, the view that is being proposed is that previously we used to create an accrual for expenses, typically services received, but for which bills have not yet been received. For example, rent payable, security services payable, electricity charges payable. These are all expenses for which we used to pass accrual entries as at the year end, because the invoice usually got received in the month of April, right? Now, those are the items where it is for even audit fees payable, for instance, right? That is also an accrual for expenses. So these are all items for which the billing from the counterparty has not happened. So you have not received the invoice from your supplier, but you have accounted the expense and you have accrued a liability for that particular expense. So those amounts are now being proposed to be shown here itself, which means those numbers will also have to get grouped within trade payable itself and not as part of other current liabilities. Historically, we used to show it under other current liabilities as liability for expenses, right? Now these amounts will have to get grouped within trade payables, and in the aging you will say that those are amounts for which the billing has not yet happened, and so you will classify it as unbilled dues. So accruals done for expenses but not billed fall under unbilled dues. Bills received but not yet due as at the balance sheet date go to not due, and where it is already overdue, then you classify it within those other 4 buckets of less than 1 year, 1 to 2, 2 to 3, and more than 3. All right. What happens when there is no due date at all? There is no due date specified in the invoice. Nothing is agreed upon. Then the invoice date is taken as the due date. All right. Or in other words, you can even take the date of entry of the transaction as the due date in the context of aging. Either of these is preferable. To whatever extent data is available, that can be taken. If invoice date is readily available, that can be taken as the source for aging if no due date is specifically agreed between the parties. All right. You are also required to segregate undisputed dues and disputed dues. And disputed, when we talk about it in this context, there should be some conscious communication or positive evidence that has happened to substantiate that there is a disagreement. It cannot be a scenario where, sir, that amount we will not pay, there is a problem with that party, but everything we are speaking over phone, nothing is documented. Okay, none of that can be accepted as disputed. There should be some positive communication either in writing through physical means or through email to substantiate there is some problem with that particular goods or services received because of which there is a dispute that is going on, a disagreement between those parties. If nothing is available in writing, then it might not be appropriate to classify it as disputed. It might have to be treated only as undisputed. Okay. Similar aging for trade receivables. Only difference is that you have a further segregation within 1 year. There it was only less than 1 year. Here you need to talk about less than 6 months and 6 months to 1 year. So that is broken down into two sub buckets. Unbilled dues and not due, pretty much the same that I explained in the context of trade payables. So unbilled revenue, which we used to disclose under other non-current assets in the past, will now have to get clubbed with trade receivables itself. And here also segregation between disputed and undisputed. And you also have to talk about or rather segregate it between those trade receivables which are considered good and those which are considered doubtful, right? So when you consider something to be doubtful, typically you provide for them because you feel that the recovery might not happen. If it is considered good, then typically there is no provision that is maintained against that receivable. So you will also have to show that classification in addition to the disputed and undisputed classification. Here also what happens if the due date is not specified or agreed upon, you can take the invoice date as the due date for the purpose of this aging. Right? So this is the financial ratios that were talked about in this particular slide on solvency related opinion to be given by the auditor. Right? So aging we have covered, trade payables and trade receivables. So these are the financial ratios that are expected to be disclosed as part of the financial statements. So you will have to disclose current year's ratio, previous year's ratio. In case there is more than 25% variance compared to the previous year, then the reason for such variance also has to be explained. And one important matter, similar to how we follow uniform accounting policies across the years, it should also, this formula also should be applied uniformly across the years. You cannot follow a different numerator and denominator for current year, and for the previous year you take a different numerator and denominator for the ratio. It has to be uniform across the years. And unless a specific change is warranted, that uniformity should also continue for future years as well, so that compatibility and comparison is feasible. And here you are also required to give a brief description of what is the numerator and denominator that is being considered. For example, current ratio, it is typically current assets divided by current liabilities. So numerator is current assets, denominator is current liabilities. Debt equity ratio, for debt you will consider term loans, short-term borrowings from banks and all of that. For equity, you will take share capital plus reserves and surplus. Debt service coverage ratio, amount available for servicing debts, which will typically be profit before tax plus interest plus depreciation as divided by the amount of principal repayment that needs to be done and the interest that needs to be serviced. All right. Now, most of these ratios are fairly simple. We have additional guidance in the institute guidance note as well. So you can take a look at it where the recommended formula is available. What should be taken as the numerator, what should be taken as the denominator and all that. It is not a hard and fast rule. It is a recommendation by the institute because depending on the nature of the business, the formula might have to be tweaked a little bit here and there. But the general understanding with respect to these ratios is available in the guidance note. So as and when you come across this scenario, you can take that into account and calculate these ratios, and preferable to link these numbers to the financial statements itself so that it is easier for the seniors and partners to review it at the end of the engagement when required to do so. All right. And there is one last ratio in this, which talks about the return on investment, which is typically something that you cannot calculate from the financial statements. All right. So return on investment is something where if you put in some money into the company, what has happened to that money into the company after a certain point of time. All right. So this is something where the value of the company comes into the picture. And this can be a little challenging, especially in the context of unlisted companies, because for listed companies, the stock prices are quoted. You can even take the quoted stock prices for calculating return on investment. But for unlisted entities, this can be a bit of a challenge. And the formula that is prescribed in the institute guidance note is also not that simple. It has a little bit of complex calculations involved. So this last item alone, we will have to do some groundwork on how to ease the process or how the disclosure needs to be done. Most of the other numbers, you will have the information available in the financial statements. You will only have to take an appropriate call with respect to what you consider as the numerator and denominator. Give a descriptive description on what is being taken and also link it to the relevant numbers in the financials. And of course, if there is a variance exceeding 25%, then suitable reasoning has to be given. So these financial ratios are also meant to help the auditor in determining the solvency capability of the company over the period of next 12 months. Right. CSR, this is a new requirement within CARO. 1 second, guys, just be back. Yeah, sorry. There was an amendment in the section that deals with CSR a few years back, wherein 2 new subsections were brought in. I think one was amended, one was inserted. So the requirement as it stands now when CSR is applicable is that in case you have some unspent money which pertains to an ongoing project, which means the project is actually happening and you have been spending, and over the course of the project, you will end up spending the unspent portion also. In such cases, the section requires you to transfer the unspent amount to a special account within 30 days from the end of the financial year. Right? This is in the context of ongoing project. In case money is still unspent, but it has not yet been earmarked for any project, and the section requires you to transfer that money to any of the funds that are available in Schedule 7. Typically, your Clean Ganga Fund, certain specific funds like Prime Minister's National Disaster. I think some of the funds are there in Schedule 7. All right. So, in case you have not spent money which was required to be spent towards CSR, and it has not been earmarked for any ongoing project, within 6 months from the end of the financial year, you are required to transfer the funds, the unspent amount, into a fund that is listed in Schedule 7. So CARO requires reporting on whether these compliances have been done properly by the company. Right. So the first clause with respect to other than ongoing project, sometimes because the 6-month timeline is there, you might be able to report only on the previous year's complaints, unless for the current year also company has already transferred money to that fund. If they are yet to transfer, then we can say as on the date of the report, it has not yet been transferred and the company expects to transfer it subsequently within that 6-month period. The second clause, it can anyway be identified because usually we don't sign off on any accounts within 30 days. Wherever CSR is applicable, that clause can be looked into for the current year itself. And a few disclosures warranted in Schedule 3 relating to CSR, which are previously not there. Because previously it was more covered more in the board's report. Of course, our institute's guidance note required certain disclosures to be made in the financial statements. Now it has been mandated by Schedule 3 itself. What is being expected to be disclosed in the financials? what is the amount that was required to be spent for CSR. Okay, it is usually 2% of the average net profits of the last 3 years. Right? That is the requirement under section 135. How much expenditure has already been incurred? Okay, so how much was required to be spent? How much has already been incurred? Whether there is any shortfall as at the year end for the current year. In case there were shortfalls in past years also, how much is the cumulative shortfall, okay, for including previous year's shortfall? And what is the reason for these shortfalls? Why the company has not been able to spend the money? Okay, whether there is some practical difficulty or the objective that was sought to be achieved has not gone through, or whatever reason it might be. And they're also required to talk about what is the nature of the CSR activity that was undertaken. Any CSR transactions undertaken with related parties, those also have to be specifically disclosed. And sometimes what will happen, expenditure would have got incurred, the payable will be there in books, the payment might happen later, right? So let's say some agency was appointed for doing the CSR activity, they raise an invoice on the company is yet to settle that invoice, right? Those amounts can still be considered as expenditures incurred, but only thing those have to be disclosed separately, and the payments will be made by the company after the year end. So the quantum alone needs to be specified separately, and the moment it required to be shown. What was the opening payable of such amounts? How much was paid during the year? How much is the additional amount that is coming to that head in the current year? And what is the closing balance? So this is in the context of CSR. I am not dealing much into applicability of CSR. Most of you guys would already know. Net profit of more than 5 crores in any of the last 3 years. If my memory serves me right, turnover of 1,000 crores and net worth, I don't remember. Okay, doesn't matter. So just have a look at it. Section 135. Been a while. I think only one company of ours has CSR applicable. Net profit is the one that is very common because there is a very low threshold. So that is 5 crores. Net worth and turnover, I don't recollect immediately. I remember 1,000 crores for turnover and 500 crores for net worth, but been a while. You might want to check at your end also once. Okay. So that's on CSR. I think, yeah, with that, CARO clauses are through. Okay, CARO clauses and the related Schedule 3 amendments are through. There are few additional reporting requirements that have got introduced in section 143 subsection 3. Okay. Now that is the subsection where we had certain questions about whether the balance sheet and P&L are matching with books, whether accounting standards have been duly followed, any director is disqualified under section 164. All right, that is the subsection where all those questions come, for which we give a separate section in the report saying report on legal and regulatory matters. All right. So in that, there are 3 more clauses that have got inserted. One is whether in case the company has declared or paid dividend during the financial year under audit, whether they have done it in compliance with the requirements of section 123. So this will apply only in cases where dividend is declared or paid. Another reporting requirement, whether the company is using an accounting software which has the audit trail available. Right? Now this clause might not be relevant for this year because the requirement itself has been deferred by 1 more year. Right? Originally it was deferred to 1st April 2022. Again, now they have deferred it by 1 more year. So it might not be applicable for financial year 21-22 as well as 22-23, although it is available in the section with respect to reporting. So that is a future requirement. You might just have to keep it in mind. And the third matter is slightly complex, but I will try to explain in the subsequent slides. Whether the company has undertaken any transactions through a pass-through mechanism, and if so, whether it has been disclosed suitably in the notes. Okay. And you are also required to seek specific representations from the management saying that any such pass-through transactions have been duly disclosed in the management. And you are also required to say whether something has come to your attention which makes you believe that the representation given by the management is not correct. Either that, basically that they have not disclosed it properly in the financial statements in Schedule 3, right? Now, what is this concept of pass-through? There are two scenarios which are envisaged. One, the company acts as an initiating party. Okay. It transfers money to another entity which acts as an intermediary for the purpose of benefiting another entity. All right. So let's say company A is the one that is being audited by us. Company A transfers funds to entity B, but it is not for the benefit of entity B, but it is for the benefit of entity C. And there can be multiple intermediaries in between. Money can go to B, then to B1, then to B2, then to B3, doesn't matter. But if money is being transferred for the benefit of some other person and not the person to whom the money is originally transferred, that is a scenario that is being talked about in this particular portion. The second scenario is where the company acts as an intermediary. All right. So we are talking about three parties here. You have an initiating or funding party. You have an intermediary. Then you have the ultimate beneficiary of undertaking this entire exercise. So a scenario where company receives the ultimate benefit is not being covered. Only scenarios where the company is initiating the fund transfer, it is acting as the initiating or funding party, is covered. Similarly, scenarios where the company acts as an intermediary, where it receives money from a funding party and passes on the benefit to another party, that scenario is also required to be covered and disclosed in the financial statements and also to be covered in CARO. Right? Now, what is the funding for? The funding can be for two purposes. One is for onward lending or investing in the ultimate beneficiary. So in the example that I gave, company A transfers money to B. B then transfers that money to C, either by way of equity investment, preferential investment, whatever it might be, or it transfers the money as a loan to company C. So that is a transaction which is covered. Similarly, in case that intermediary uses the funds received for the purpose of providing a guarantee for the benefit of ultimate beneficiary or to give assets as security for the benefit of on behalf of the ultimate beneficiary, those sort of transactions are also covered. But the first leg of the transaction has to be a transfer of funds. After transfer of funds, the intermediary then either utilizes or transfers those funds itself into the ultimate beneficiary or provides a guarantee or security or similar transactions for or on behalf of the ultimate beneficiary. All right. So we talk about two scenarios, and in each of those scenarios, the first leg has to be a transfer of funds. The second leg can be a transfer of funds by way of loan or investment, or it can also be a transaction of providing guarantee or security on behalf of the ultimate beneficiary. Okay. Or on behalf of the ultimate beneficiary, right? So now what is required to be disclosed in this? In the scenario 1, where the company acts as the originating party, the company is the one who is transferring funds to the intermediary. They will have to disclose the quantum of such transfers made to intermediary entities, basic details of, to whom it was transferred, how much was transferred, what purpose and all that, and how much of money was onward transferred by the intermediary. So how much transfer happened from A to B and what did B do? How much B has transferred to C or to B1 or to B2 or B3? Yeah, there could be multiple intermediaries in between, right? So this is typically meant to cover cases where a lot of entities have a multi-tier structure, right? And they transfer funds from one country to another entity in another country, and the funds get routed through multiple countries where it is becoming difficult for the regulators to identify the trail of the transfer of funds. So to have more information in place in respect of these transactions, the disclosures under this clause are now being sought for. So we've talked about transfer of funds from A to B. What did B do with those funds, whether it transferred it to directly to the ultimate beneficiary or if it has transferred to other intermediaries, details of such transfers, and details of any guarantees or securities provided by the intermediary to the ultimate beneficiary or on behalf of the ultimate beneficiary. So A is the first leg of the transaction, B and C are the second leg of the transaction. And the company is also required to declare about their compliance with FEMA regulations, Companies Act and PMLA with respect to these transactions. In case of any non-compliance, that also has to be specifically disclosed. In the second scenario, the company acts as an intermediary, so it will have to disclose how much money it received from where, from which party and all that, and what has happened with that money, whether it has transferred it to the ultimate beneficiary or to other intermediaries, or it has used it for giving a guarantee or security to the ultimate beneficiary. And here again, a specific declaration on compliance with FEMA, PMLA and Companies Act. Now, I think layers I would have. Okay, I'll cover these layers also so that it's a little related. So now one important, I will not delve too much on FEMA and PMLA because those are much complex aspects which will require separate discussions. But one specific aspect in the context of Companies Act, which I would like to highlight. See, section 186 has a restriction that a company cannot invest in another entity through more than 2 layers of subsidiaries, which means you have company A. Company A can have subsidiary B. B can have subsidiary C. Subsidiary C can then invest in D. So you have A, you have D on the other end. On one end you have A, on one end you have D, and you have 2 intermittent layers, B and C. So B is a subsidiary of A, C is a subsidiary of B, D is a subsidiary of C. So A has indirectly invested in D through 2 layers of companies. One layer is B and the other layer is C. Section 186 prohibits investment through more than 2 layers of subsidiaries unless you are making some investment in a foreign entity that local regulation permits such investment and all that, right? But in the Indian context, as far as the Indian company making investment is concerned, you cannot have more than 2 layers of subsidiaries. Now, there is also a similar restriction that was brought in by way of the restriction on number of layers rules, right? And if the number of layers prescribed were crossed, then it had to be reported because this was a requirement that was brought in few years back. By that time, there will be certain instances where those restrictions would have already got crossed for downstream investments. So what the government said, if you have already crossed the prescribed threshold, you report that fact to us and ensure that you don't increase the layers going forward. If you have already crossed, fine, you have done it in the past. Let me not penalize you for that, but ensure that you don't increase your layers going forward. And if at all in the future number of layers come down, you maintain it that level so that you don't cross the threshold once again, right? So this compliance also becomes relevant in the context of these 2 scenarios that we talked about, where the company either invests through intermediaries or it itself acts as an intermediary and invests further in ultimate beneficiaries. In those scenarios, you might also have to look at compliance with the restriction on number of layers rules, as well as the requirements of section 186 that you cannot invest through more than 2 layers of subsidiaries. Right? I have covered this in detail for your understanding, more from economic perspective. In lot of entities which do not have multinational operations, this might not be very relevant. All right, but just know the requirement from an academic perspective and keep it in mind so that if at all you have an exceptional scenario where we are required to cover this, you can handle it suitably. Right. These are to do with some of the critical changes. Few other elementary matters. Rounding off has now become mandatory. Right? Previously, it used to be optional. Schedule 3 used to say it may be rounded off, but now rounding off has become mandatory. They have replaced may with shall, which means you cannot disclose numbers in actual rupees. It has to be rounded off the nearest hundreds, thousands, lakhs, or millions if your turnover is below 100 crores. If it is 100 crores or more, then you are required to round it off to lakhs, millions, or crores. Okay. So depending on the turnover involved, the rounding off will have to be done mandatorily. Now, how do we do this easily? We usually use SumFS formula to bring numbers from the trial balance to the schedule or the notes. There itself, you can have a round formula to round it off to the relevant number. You round it off, divided by, after dividing it by, say, 100 or 1000 or a lakh, depending on the round off that is being considered. Okay. And another cosmetic change, the term total revenue as it appeared in the P&L has been reworded to total income. So we used to have revenue from operations, we used to have other income, and the total used to be talked about as total revenue. That is now being reworded to total income. Just a cosmetic change. And the rounding off that you decide to use has to be used uniformly across the financials, even in the descriptive notes. For example, you will have one disclosure where you talk about the contribution made to provident funds, right? Even there, you will have to use the same unit of measurement. There, you can't say you will talk about the numbers in actual rupees. If you're rounding off to thousands across the financials, even for numbers that appear within your descriptive notes, same unit of measurement has to be used. And preferably, the same unit of measurement can also be used in the audit report to the extent feasible, so that there is uniformity in the entire annual report. This is an additional disclosure within your share capital note. We are already disclosing shareholders holding more than 5% shares held by holding company and all that. There, additionally, you are also required to talk about the movement in the promoter shareholding. How much did each promoter hold at the beginning of the year? How much do they hold at the end of the year? How much is the percentage of change? And this has to be disclosed for each class of shares. For example, a company has issued both equity shares and preference shares separately for both. Even within equity shares with differential rights, even then you will have to show it separately for each class of shares. And the term promoter is as defined in the section 216 of the Companies Act, where it will typically talk about the ones who founded the company, or more importantly, who have been declared as promoters in the annual return of the company. So what you can do is take a look at the previous year annual return, which should have got filed in form MGT 7. And depending on who have been declared as promoters, same persons can be considered for this disclosure. In case there has been any change in the promoter itself, then suitable changes have to be done in the note also. In case the company has entered into any scheme of arrangements, the company is required to disclose whether the effect for the scheme has been given in books in accordance with what was contained in the scheme, and also whether it has been done in accordance with accounting standards. In case there are any deviations, explanations for the same. In some circumstances, the tribunal or courts might approve a scheme, although the accounting treatment might not be in accordance with accounting standards. In such scenarios, we can talk about the fact that there is non-compliance with accounting standards, but the fact that it is in accordance with the scheme as approved by the tribunal or the high courts. This I think I have already covered. Yeah. This is again a Schedule 3 requirement, nothing to do with CARO. For the regulators to understand if there are any transactions with companies which have been struck off, because usually sometimes people tend to launder money to other entities which then become defunct, which are no longer in existence. So in case the company has entered into transactions with companies which have been struck off, either under the old company law or under the, I think right now it is, previously it used to be fast track exit scheme. Right now I think it is striking off. So in case the company has transacted with any such companies, then it is required to be disclosed here. So whether the company has invested in any securities of that struck off company, equity shares, preference shares, whether any money is receivable or payable to or from that company which has been struck off, any shares of this company which have been held by another company which has already been struck off. Sometimes what might happen, one of the shareholders of the company might be another company, and that other company, which is a shareholder, might have got struck off. So those amounts also have to be disclosed here. And other than these four, any other transactions or balances that are outstanding will also have to get disclosed. And for this purpose, ICAI recommends disclosure of transactions even if they have been squared off during the year. So we need not restrict your disclosure only to what is outstanding at the year end, because in one other slide I would have said it is sufficient if we disclose what is outstanding, but in the context of transactions with struck off companies, even transactions which have got initiated during the year and squared off during the year also need to get disclosed. And in case the company which was struck off has been restored prior to approval of financial statements, these days you also have a process where a company which was struck off can be revived and it can be brought back to existence. In case any struck off company has got revived and it is back in existence, for those entities, this disclosure might not be warranted. Balances outstanding with those entities need not get covered for this table. Few other minor matters. Total revenue rewording to income I have already covered. One additional line item under the note on revenue from operations. The existing sub items are in the context of entities which are operating for profit. There was nothing that talked about entities which are operating as not-for-profit companies under Section 8. So there is one line item that is being introduced to disclose the grants or donations that have been received by the not-for-profit entity as a separate line item. Previously, such entities have already been doing that because they could not get covered in any of the other items. It is now being brought into the schedule itself. And last one, very rare scenario. In case the company has undertaken transactions in any cryptocurrencies or virtual currencies, crypto assets, then the profit or loss on such transactions, whether they are holding any such currencies as at the balance sheet date, and whether any deposits or advances have been received from any person for the purpose of such trading or investing. So in case you have borrowed money for doing such trading, then that also has to be disclosed in the financials. So this is pretty much what has been introduced as changes with respect to CARO and Schedule 3, and also 3 additional clauses in Section 143(3), which we talked about in one of the slides with respect to compliance with dividend declared paid, audit trail matter, and transfer of funds through pass-through mechanism. Right? For this year, audit trail related reporting will not be there, but the clause on compliance for dividend and pass-through mechanism will apply. If it is not applicable, we will say that it is not applicable or suitable wording, but there should be one particular clause in the audit report which covers those two matters. Right. I have 2 more minutes left. Okay. Fortunately, today we have completed on time. Very rare circumstance in our office. I think because it was a monologue today, it got completed. Otherwise, it would have got extended. Anyway, so any questions that you guys might have?
Sir, under CARO, in
Yeah.
immovable property clause,
Yeah.
I think they have excluded this leased assets. Whether it is also covered under.
It is covered. So what they would have said is the initial clause will say other than leasehold property.
Yes.
But subsequent sentence they will say in case leasehold property is not held, the lease deed for leasehold property is not held in the name of the company, disclose that also.
Okay.
So for in the first clause, title deed அப்படின்னு ஆரம்பிக்கும் போது they have excluded leasehold property. Because for leasehold property you will not have a title deed.
Yes.
It is not a sale deed that will get executed. So they excluded leasehold property from that particular sentence. But in the next sentence, they will ask you to report on any instances where leasehold properties for which the lease deed is not in the name of the company. Okay. So essentially both get covered. So if it is your own property, whether title deed is in your name, if it is a property taken on lease, whether lease deed is in the company's name. Non-compliance with either of these will require reporting to be done.
Sir, in case of title deeds of immovable properties are held in the name of the company. In case of leasehold property, lease agreement should be there. So,
correct.
Which they are referring to the immovable property, which is the building situated in that leasehold land.
It could be building situated on leasehold land or land itself taken on lease, whichever it might be. Both land and building taken on lease are land alone taken on lease, own building constructed on leasehold land, whatever it might be. Only immovable properties though, either land taken on lease or both land and building together taken on lease.
Land taken on lease, building constructed on the said land by the company, whether disclosure will be warranted?
If the lease deed is available in the name of the company, it should be okay. No specific disclosure may be warranted.
Okay, lease deed for the land is available in the name of the company.
Yeah.
If on the building company title இருக்குதா?
See, there is no document that will be available. But if you look at the Transfer of Property Act, when land is taken on lease and the lessee constructs something on that land, that building becomes the property of the lessee, and he is entitled to seek compensation from the lessor if at all he is vacating the premises also.
Okay.
So that is the provision that gives title with respect to the building. There will not be any document per se that you might have with respect to the building constructor. So as long as the lease deed is available for the land that has been taken on lease, should be fine. One aspect, however, that we can debate on and deliberate internally is most of them don't get their lease deeds registered. Okay, that is a very common phenomenon that we notice, because any lease beyond 11-month period is ideally required to be registered with the sub-registrar office. Relevant stamp duty and registration fees has to be paid, which most of the entities don't do because they feel it is an additional expense. We can probably think through internally on whether, in case of non-registration, any disclosure or reporting requirement is warranted. I haven't gone through the institute guidance note also in detail in the context of this class. We can probably take a look at whether there is any additional guidance in the institute GN as well. Others?
So next in the capital WAP.
Yeah.
You have mentioned we have to disclose the time or cost overrun to be complete. What we have to mention actually in that table, whether estimated cost for completion.
No, what is required to be disclosed? You need to, whatever is the closing WIP,
okay,
will have to be parked in the relevant bucket.
Okay.
All right. And you need to say when that project is expected to get over.
Okay.
For example, project 1, if it is going to take 2 more years, then you will show that amount in 1 to 2 years.
Okay.
So this is where you will show the number. Okay. Let's say there is another project suspended, it will likely take more than 3 years, then whatever is the outstanding CWIP amount, you will disclose here.
Okay, you have mentioned you have to disclose cost overrun. Then
those projects where there is time or cost overrun, you need to also talk about when they will get completed. It all depends on what the board has approved. Usually when they go for bank loan, they will submit a proposal to the bank also as to how much they are going to spend. Right? So you can look at internal documentation that is available. What was the original plan of the company in terms of the timelines? Usually when they go for bank loans, both of this information will be there in the bank proposal. In bank proposal, they will say, we will, install the machinery by so and so date. That is when we will start commercial production. So until then, we need moratorium. After that, we'll start repayment and all that. Yeah. So the bank proposal will typically give you an idea of the timelines and cost budgets involved. If at all they have not gone for bank proposal, you can only look at board resolutions, and if required, take representations from the management on what their original timing and cost plan was. At the end of the day, we will have to rely only on their internal documentation if there are no bank loans. If there are bank loans, we can also corroborate their internal documentation with what has been submitted to the bank as well. Okay. To be very frank, the second table could have been dealt with in a slightly different manner, because for cost overrun, it might be more appropriate for them to ask how much more of money needs to be spent in addition to the timeline. But the present table is such that they're asking only for the projected completion timeline and not how much more cost is required to be incurred for cost overruns. So if they had broken it into those two types, the disclosure would have been more meaningful, to be very frank.
Okay. So next is on inventory.
Yeah.
We have to mention the difference between quarterly statements submitted to bank and what is there in books, right?
Correct.
What they have submitted to bank, whether we have to get it from client or from directly.
Exactly. I forgot. I wanted to mention it, but I forgot. Good point, Satyan. So what I would recommend, see, typically what happens, they will get a seal from the banker, but that will be only on the first page. That will have no information. It will only be a covering letter. So what would be more appropriate for all clients, for all corporate clients, whether CARO is applicable, not applicable, we can, for cases where we have already circulated bank confirmations, we can send one more confirmation request specifically for this, asking them to indicate what is the quarterly stock and the receivables that have been submitted to the bank. If possible, we can even request a copy of the same to be provided to us.
Okay.
Okay, because at the end of the day, if somebody wants to play around, they can very well play around. Covering letter கீழ வேற ஏதாவது வச்சாங்கன்னா நமக்கு என்ன தெரிய போகுது? Because they usually don't get a seal in the subsequent pages. Usually the bank affixes a seal on the covering letter and gives it back to them. They will get it and keep. If at all எல்லா பேஜ்லயுமே பேங்கோட சீல் இருக்கு அப்படின்னா then that is okay. If that is not there, most appropriate way would be to get it confirmed by the banker itself and ask them to share a copy.
Okay.
And where we can even undertake this exercise informally by asking the client to speak to their bankers and have the bankers email scan copies of those statements directly to us. That will also, if at all the confirmation process is taking some time, we can ask the client to at least have the bankers share this information formally over email directly to us.
Okay.
Because that will be a more appropriate way to identify what has actually reached the bank rather than relying on what is available with the company, because that can always get changed. We know clients who can change. Satyan. There are clients who will say we will give this for now and subsequently bank known to us only we can change. அதனால வந்து ideal to get it confirmed by the banker itself. Okay. So what we can do, just think about what additional clause we can include in our bank confirmation request for this.
Okay.
We already covered 7-8 items, no? Current accounts, fixed deposits, bills, yes, discounted and all that. So we'll have one more item on this, and we will specifically request that copies of the stock statements and the receivable statements are to be directly shared with us either by email or in hard copy. Even for cases where we have already circulated bank confirmation requests, we can circulate this alone as a separate request for this year. Where we are yet to circulate bank confirmation requests, this also can be included as an additional clause within the request. Okay. maybe sometime later in the day, just put some thoughts on how we can include this, what sort of template we can use. We can prepare a draft and share, then we can review and take a final call.
Okay. So next is on this undisclosed income.
Yeah.
Sir, can you explain it again? I'm not unable to get it. What you're calling it as undisclosed income?
See, sometimes for example, there will be a client where they have incurred cash expenses of 50 lakhs.
Okay.
Supported only by vouchers.
Okay.
Department might keep on asking some information, so they will be able to give. Department might dispute genuineness and all that.
Okay.
Okay. For the assessee wants to close the scrutiny rather than waste time on this matter.
Okay.
Okay, so they say, okay, sir, you are not convinced with the evidences that we have provided.
Okay.
In order to close the assessment, although I am of the view that all of these expenses are genuine, to buy peace with the department and close this proceeding, I am willing to offer 10% of this as an additional income. You treat for 10% of 50 lakhs, you treat it as expenditure not supported by duly authentic vouchers. You make an addition, I am okay.
Okay.
Okay, this is an addition that is not being, although it is being done voluntarily in that sense, it is being done with the purpose of closing the proceeding. It is not a case where the client, the assessee accepts that it is an income and offers. Assessee does not accept it as an income, but for the purpose of closing the proceeding, it is being offered.
Okay.
Those sort of transactions might not have to get covered here. But in case there is a survey that comes, there is 2 crore of cash available. The assessee says, yes, I sold some scrap out of books. I did not raise invoice. I collected cash for that. That is the income that is sitting as cash. I am offering it to income now.
Okay.
That is a voluntary disclosure where client assessee itself commits that, yes, I did not disclose it. I am disclosing it now.
Okay.
So in a scenario where client is of the view that it is not actually so, but for the purpose of closing the proceeding, I am offering it, it need not be covered here. If the assessee itself says that, yes, this is an income earned by me, which was not disclosed in the past, I made a mistake, consciously, unconsciously, whatever it might be, and they are offering it to income, that will have to get covered in this class.
Okay.
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 Anything else?
So regarding the Benami proceedings,
Yeah.
under the Benami, sir,
Yes, Shankar, go ahead.
any other external sources are available from where we can find it out whether the client is being covered under the proceedings?
Nothing that I am aware of as now. These proceedings are initiated by the income tax officials only. Okay, and I think Ramnath sir has handled 1 or 2 Benami transaction cases. So what we can probably we can discuss with sir whether these proceedings also appear in the income tax portal of the assessee itself under e-proceedings.
Okay.
Okay, we can just check with sir once. In case it is appearing there, that itself will give us an idea of whether any proceedings are pending against the company. We will anyway take a representation, but this will be an additional means of ensuring that we don't miss out on something. Deepak, any idea? Benami transactions, anything that comes on the income tax login? Is Deepak there? I saw him join in between. Not sure if he's still.
Was that, sir? No, sir. He's not.
He's not there. Yeah.
So next is on this borrowings.
Yeah.
You have mentioned we have to identify whether the short-term borrowings have been used for long-term purpose and vice versa.
Correct.
Whether that is applicable also for this loan from directors. How will you identify
Ideally, yes.
Ideally, it should be yes. But how will you
Yes.
identify whether the purpose of fund? Whether should we
No,
get
see,
any
it all
declaration?
depends on where you're classifying that loan from director. Are you treating it as a short-term loan or a long-term loan?
Okay.
If you're treating it as a long-term loan and you have adequate documentation in place to substantiate that, then it is not a problem.
Okay.
If it is treated as a short-term loan, but it is in the ending, you show it under short-term borrowings as loans repayable on demand from directors, but then end up you acquiring fixed assets using that money, then it is a concern. In most of the cases, directors fund it with a long-term intention only.
Mm.
So we can just look at getting some paperwork done so that the amount can be classified as being long-term in nature.
Okay, nature we can identify. So the purpose of borrowing, how we will justify
So you are talking about
the purpose.
in that case, I don't think purpose will be warranted unless there is documentation in place to say the director has given the loan for this purpose only.
Mm-hmm.
Because when you borrow money from banks or financial institutions, there is an intended purpose. In addition to long-term, short-term, there is a specific purpose also involved.
Mm.
When you get loans from directors, usually there is no specific purpose that is aligned with that fundraise, and so it might not be a. You will have to only look at the utilization between short-term and long-term.
Okay.
And in very rare circumstances, what might happen if bank has a stipulation that 10 crore project, 7.5 crores I will give, 2.5 crores has to be mandatorily infused as unsecured loan from the director. In that scenario, we might want to look at whether that money has actually ended up going for that project only.
Okay.
Okay, although not immediately, at least at some point of time, project முடியறதுக்குள்ளேயா அங்க போயிருச்சான்னு பார்த்துட்டோம்னா should be okay.
Okay.
But that is more of a bank stipulation rather than the stipulation of the director who is lending the money.
So with respect to the short-term funds being used for long-term purposes,
yeah,
we are happy so far as there is cash generated from operations being positive. Are we in such a situation? Because I see all the projects, temporary fixed assets, not temporary, items of lower value are generally purchased from the cash credit account, and they are not being specific.
That is okay. See, when you look at the balance sheet, your current assets are more than current liabilities. Life is very simple. If it is not so, if there is current portion of long-term borrowings and that can be excluded, and after that current assets is exceeding current liabilities, then again no problem. Okay. Only when these two are not satisfied, then you will have to start digging a little bit deeper as to what has actually happened, whether there is a crisscross utilization or some challenges there. Okay, so balance sheet level in the render amounts பார்த்துட்டு அதிலேயே if we are satisfied, then we don't have to bother about, because in between during the little bit of crisscross utilization, that's okay, that is part of the business, that's not something that we need to be too bothered about.
Also with respect to this revaluation, revaluation covered within the scope of AS10, or the term can be referred to as a general revaluation, where downward revaluation will also be covered.
Any revaluation will get covered.
So downward,
not only upward,
such as impairment, whether we will be required to report it.
See, impairment is a little different from revaluation. So impairment is covered by a separate standard. When you follow revaluation model, you are required to do a revaluation, I think at least once in 3 years or 5 years. I don't remember the exact timeline in the standard. Okay. Before doing the next revaluation, there might be some impairment for which you create an impairment loss. That is different. So what you do as part of AS28 with respect to impairment is not something that needs to be considered as revaluation. Only the revaluation that falls within the scope of AS10 when you follow revaluation model needs to be talked about here.
Okay, so the clause gets triggered only when revaluation model of AS10 is followed.
Correct. And if at all impairment is a significant number, then it might make sense to show that as a separate line item, considering the numbers involved as a better method of disclosure.
As a part of Schedule 3.
Correct. Yeah. In the FA note, if at all it is very material.
Okay. So regarding the pass-through income,
in fact, I think it is actually required to be disclosed separately. Impairment. That is why.
Yeah.
Additions, deletions. I think there is a separate line item for impairment itself already. Yeah. Pass-through transactions, Shankar.
Pass-through transactions, a matter which we were already earlier discussing inside the team, whether mutual fund transaction needs to be reported, where the company being a party who funds them to invest in mutual fund.
But it is not for the benefit of somebody else, no. It is for the benefit of the company only, no.
Okay.
That is not going to benefit the company whose shares they are getting. That company is not going to get any benefit. The shares are changing from one hand to another. That's all.
So at every pass-through transaction, there will be the company which is intending for the benefit. In any such transactions where you could provide us an example? Because we were initially thinking about this venture capitals and all those funds.
This is more intended to cover cases where you have intermediary holding companies and the money then reaches an ultimate operating company. That is my understanding as of now. Where you have multiple layers of making investments and the money finally reaches an ultimate beneficiary. So those are the kind of transactions that the government is trying to identify and seek disclosure of in the financial statements. But to be very frank, considering the nature of the transaction and very limited applicability, I have also not done too much of research on this. I have only developed an understanding of what is required to be covered in the disclosure and CARO. Probably I can get some more research done to understand few examples of when these transactions would fall within the scope of this clause. I think as it stands now, two to-dos for me, one on the Binami related matter and this pass-through related examples. Okay. Next, anything further?
சார் ஒரு சின்ன டவுட், இந்த பாஸ் த்ரூ மெக்கானிசம் இது கரண்ட் இயர்ல நடந்திருக்கிறதுக்கு ரிப்போர்ட் பண்ணா போதுமா, இல்ல ப்ரீவியஸ் இயர்ல ஏதாச்சும் நடந்திருந்தா அதையும் ஐடென்டிஃபை
only current year, only current year.
சார் இப்போ தெரியாம ஃபண்ட் ட்ரான்ஸ்ஃபர் பண்ணிட்டாங்க, லைக் பை மிஸ்டேக் பை எரர் ட்ரான்ஸ்ஃபர் ஆயிருக்கு, அந்த மாதிரி சினாரியோஸ்ல
பை மிஸ்டேக் ட்ரான்ஸ்ஃபர் ஆனா திரும்பி வந்துடணும், வரலன்னா இட் இஸ் நாட் மிஸ்டேக்.
ஓகே, லைக் சப்சிக்வெண்டா அதை ரெக்டிஃபை பண்ணிட்டாங்க அப்படின்னா அதையும் ரிப்போர்ட் பண்ணணுமா?
இட்ஸ் a genuine error, it is okay ma. அப்புறம் அக்கவுண்ட் நம்பர் மாத்தி ட்ரான்ஸ்ஃபர் பண்ணிட்டாங்க அப்படின்றீங்களா, that and all will not get covered here boss.
சார் இப்போ ப்ரொவைட் கேரண்டி அப்படின்னு ஒரு அல்டிமேட் பெனிஃபிஷியரிக்கு கேரண்டி ப்ரொவைட் பண்ணிருக்காங்க, அதை எப்படி சார் ஐடென்டிஃபை பண்றது?
That will depend on whether that intermediary has actually given a guarantee. It's a factual matter. You might either have to get some information from the company directly, or if possible from that intermediary itself. You can look at that intermediary's financial statements whether any contingent liability is disclosed with respect to guarantees given.
Okay.
Others, any questions? Hello?
So, nothing. That's all.
Okay. Fine then. I know it was a slightly boring session, only content, no fun. Anyway, it has to be this way, you can't help it. At a junior level, I'm not sure how much of this was capable of being grasped. But anyway, the recording will be available. So please go through the actual class of CARO itself once. Also try to read what guidance is available in the Institute guidance note. And if at all you come up with any queries, open questions, challenges as part of the audit, you can feel free to discuss with your team leads and the partners so that we're able to report properly in the relevant classes. Okay. For schedule 3 related changes, have we updated our template, guys, by any chance for any
Yes,
case?
sir. We have updated already. We have shared the draft, I think. I'll share this in this group.
Just to share a link, I'll also take a look, and if there is some little bit of modifications that we can plan, we can execute it so that we have it ready for the other cases. Okay. All right then. Thank you, guys. Thanks for the patient listening. Hope it was useful. We'll have I think a lot of the recordings we have not yet saved it to stream. Satyan, once you complete it, you share a downloadable link for these recordings.
Okay.
I'll upload it to stream and share a link from stream also. Okay.
Okay, sir.
Okay. Yeah. All right. Thank you, guys.
Thank you, sir.
Thank you.
Bye.
Thank you, sir.
Thank you.
Or the equipment for